I think our countries are adjusting. We've seen a lot of progress they have made in fighting inflation. Constraint on both the supply side and the demand side is affecting prices. We have seen a dramatic decline in European exports to Russia, particularly exports of goods that are under sanctions.
The 2022 full-scale invasion of Ukraine by Russia was a massive contributor to skyrocketing energy prices across Europe. Now, prices have stabilized for oil and natural gas, but some countries in Eastern Europe and Central Asia are still paying significantly higher prices, which is slowing down entire economies. We're joined now by the European Bank for Reconstruction and Development's chief economist, Beata Jaworczyk. Beata, the areas that you cover, some of them are failing to recover. What are the chief challenges facing Eastern Europe and Central Asia?
Well, we are seeing a big energy shock that is affecting the European continent. Prices of natural gas in Europe are 4 to 5 times as high as in the United States. And this is eroding European competitiveness. Moreover, if you believe future markets, there will be even a small uptick in these prices as the heating season kicks in. Even the Draghi report, the talk of all European capitals this week, pointed out that in Europe, electricity costs are 2 to 3 times as high as in the United States.
The report delves into the way that EBRD countries are adjusting to the new geopolitical and geoeconomic realities. But stepping back, what new realities have surprised you the most?
Well, we are seeing big geopolitical shifts. Take trade associated with Russia. Russian exports of energy have been redirected, for the most part, from Europe to China and India. European exports to Russia dropped dramatically, and to some extent, they have been replaced by exports from Turkey and China. And particularly, this is visible in products where Western trademarks had a significant market share. When you look at flows of foreign direct investment, most flows are happening within geopolitical groupings. So the Western grouping or the China-Russia grouping, there is much less flow happening between the two. So investment from Russia is not flowing, neither is FDI going to Russia. Similarly, we see less FDI flowing from the US to China.
Speaking of Russia, more than 2 years into its full-scale invasion of Ukraine, Russia has been hit by wave after wave of sanctions, yet their economy is growing at a pretty healthy clip, at least for the first half of this year. How has Russia's economy not only survived, but seemed to thrive?
Well, the dramatic drop in European exports to Russia stimulated local production. Increased expenditure on defense has also led to greater production. And this, coupled with hikes in wages, with subsidized credit, with increased government spending, meant that Russian economy is growing quite fast. But in fact, it is actually overheating. And we project a sharp slowdown next year. And actually, that's what the Central Bank of Russia is also projecting.
Yeah, your forecast was less optimistic for next year. One item that jumped out to me from the report were labor constraints. Can you talk more about what are the factors at play for the forecast for 2025? Certainly, shortage of labor matters. This is associated with mobilization, with disrupted production. But also, we are slowly going to see the impact of sanctions, cutting off Russia from
exports of advanced products from the Western world, exit of foreign multinationals means that productivity growth in Russia has been slower. In this sense, sanctions are working, but they are working slowly. And the effects on productivity growth are going to be visible only with a delay. And we think that they are already going to be visible starting next year.
Also next year, the EBRD has revised down the growth forecast for Ukraine. What are the growth prospects for that country?
Well, given the situation, it's very hard to make predictions for the following year. What we saw was very strong growth in the first half of this year. That was interrupted by bombing of the electricity generation infrastructure. And that has put Ukraine in a very difficult situation. That is most likely going to lead to rolling blackout. This means that electricity costs are higher. That makes it difficult for the private sector to cope. So even though there are some positive developments, such as the Black Sea corridor is functioning. It allows for exports of grain, also exports of metals and ores. Some even container ships are going there. But the high cost of electricity and the limited supply of electricity has put the country in a very difficult situation.
I want to turn back to energy for a moment. Your report outlines that oil and gas prices have stabilized to the average levels seen between 2017 and 2021, but gas still remains expensive in Europe. Why?
Well, Europe has made a remarkable switch when it comes to its energy supply. This switch meant that a lot of gas is reaching Europe through LNG facilities rather than via pipelines. And LNG exports and imports are limited by infrastructure. And LNG terminals are expensive to build. They take time to build. So this constraint on both the supply side and the demand side is affecting prices. And that's why in Europe, we are paying for natural gas 5 times as much as what it costs to purchase it in the United States.
Is this just a matter of a bottleneck? As more terminals are built, will the price come down, or can we expect elevated prices for years to come? Well,
energy markets are often volatile. At the moment, I would worry more about the oil markets, even though prices are actually stable and prices have been low by historical standards. The conflict in Middle East and the possibility of its escalating could actually translate into much higher oil prices. So that's a big unknown. That's something that's going to affect world economy as well as the European economy in the near future, this uncertainty associated with oil prices.
Part of the story here is Russia, prior to the invasion, had woven an extremely complex web of energy dependencies. And then after the war started and sanctions were ramped up, new networks had to be drawn up. How have energy imports shifted?
We have seen a remarkable adjustment of energy imports in Europe. I think few people 2 years ago expected that we would be able to adjust so well. Remember, 2 years ago, there was talk of possible shortages. We managed to avoid them. We managed to source more energy from Norway, from the United States. New LNG terminals came on board. And that has definitely helped, though, of course, we are still facing very high prices of natural gas in Europe. Now, what we did less well was limiting Russian ability to export energy. Russia has managed to redirect its exports to China and India. What we show in the report is that on the import side, there isn't big difference between prices for Russian gas and for gas imported from other places. So this is suggestive of Russia receiving higher price this year for its oil exports, for its energy exports than it was receiving before. And that's because, the price cap that was introduced was not implemented by all countries globally, which of course has limited its effectiveness.
Beata, I was surprised to hear that you thought that sanctions still could have an impact on Russia 2.5 years on. What are the implications of sanctions as we move forward?
Well, sanctions had cut off Russia from the SWIFT messaging system, which is needed for international trade transactions. And that means that it's much harder for Russia to process payments in Western currencies. So what we have seen is Russian importers switching to using currencies of other countries. So for instance, using the Chinese currency or the Indian rupees or the currency of the United Arab Emirates.
What countries have cut their dependence on Russia the most, especially in light of these sanctions?
Well, we have seen a dramatic decline in European exports to Russia, particularly exports of goods that are under sanctions. So these are dual-use goods, goods that could enhance Russia's military industrial potential, as well as luxury goods. I don't know whether you're aware of the fact that, for instance, champagne is under sanctions. As is Asti Spumante that Italy used to export to Russia. You see that Italy dramatically declined its exports of pasta to Russia, and now Russia is importing more pasta from Central Asia. So certainly access of Russian consumers to luxury goods has been less easy than before.
Zooming out, and of course not asking you to look into a crystal ball, so to speak, are you optimistic about the prospects for the countries covered by the EBRD?
I think our countries are adjusting. We've seen a lot of progress they have made in fighting inflation. This disinflation process we observed over the last few years has been very fast by historical standards. For the most part, countries have managed to avoid hard landing. Where the situation is more challenging is on the fiscal side. Countries are facing now a higher cost of borrowing in international markets. For instance, as the war started, Central Europe is paying more relative than Germany for its borrowing. This differential between the cost Germany is paying and Eastern Europe is paying has gone up, and it hasn't declined since then. In the environment of higher interest rates, servicing the public debt is more challenging. And this is particularly something that is visible in North African economies, where the cost of debt servicing is eating up several percentage of GDP. In a sense, the cost is equivalent to several percent of GDP, and it's eating up a large part of government revenues.
That's the European Bank for Reconstruction and Development's chief economist, Beata Jaworczyk, joining us from London. Beata, thank you.
Thank you, Cassandra.